Welcome back to Explain the Charts, where we break down the most important price movements in the global markets. Today is March 25th, 2026, and the NZDUSD pair is currently at a massive crossroads between technical resistance and geopolitical uncertainty. Recent headlines suggest that traders are flocking back to the US dollar as a safe haven due to ongoing conflicts in the Middle East and mixed signals regarding US-Iran negotiations. Furthermore, New Zealand's economic data has been less than stellar, with Q4 GDP growth coming in at only 0.2%, missing the market expectation of 0.4%. This disappointment, combined with a negative revision of New Zealand's credit outlook by Fitch Ratings, has placed the Kiwi under heavy selling pressure. Technically, the pair is struggling to maintain its footing after a failed attempt to break through major resistance levels earlier this week. As we open the one-day chart, we can see the broader trend has turned decidedly bearish over the last several months. The price is currently trading around the 0.5824 level, which is a significant drop from the 52-week high of 0.6121. One of the most important technical features on this daily chart is the 200-day simple moving average, currently sitting near 0.5825. In the news, analysts like Anton Karatanov have warned that a daily close below this 0.5825 level could open the trapdoors for much lower prices. Switching over to the one-hour chart, we get a much clearer picture of the intraday struggle and the failed recovery attempts. Notice the price spike on March 23rd, where the Kiwi reached as high as 0.5887, attempting to break the hurdle at 0.5870. This move was likely a reaction to easing geopolitical tensions when President Trump postponed strikes on Iranian infrastructure. However, that bullish momentum was short-lived, as the pair was rejected sharply near 0.5890, which aligns with the declining 20-day exponential moving average. The inability to hold above 0.5850 is a significant bearish signal for short-term traders. We are seeing a series of lower highs on this time frame, which reinforces the bearish bias mentioned by FX Street analysts earlier this week. The 14-day RSI on the daily time frame was near 40, and here on the hourly, we see it struggling to cross the 50 midline, suggesting bears remain in control. Support is currently holding near 0.5820, but the repeated testing of this level makes it increasingly fragile. If this support zone fails, the next logical target for sellers is the January low of 0.5711. Traders should also be aware of the upcoming U.S. economic indicators, such as initial jobless claims and the University of Michigan Sentiment Index, which could fuel further USD strength. To see the most recent price action in detail, let's look at a filtered range on the 15-minute chart between March 23rd and March 24th. During this 48-hour window, we can see the sharp reversal that occurred after the Kiwi failed to sustain its gains above 0.5880. The price action shows a clear double top formation near the 0.5888 level before cascading back down through 0.5850. This specific range highlights how news of the New Zealand trade deficit narrowing provided only a temporary boost before the overarching bearish trend took over. We can see high-volume selling candles as the price broke back below the 0.5840 support-turned-resistance level. This time frame clearly displays the rejection slide from the 200-day SMA that was mentioned in the TMGM market news reports. Every attempt to bounce back was met with fresh sellers, which is a classic sign of a market in a defensive posture. The consolidation we see late on the 24th suggests that the market is waiting for a catalyst, likely the Federal Reserve's policy guidance. With the Fed widely expected to hold rates steady between 3.50% and 3.75%, the Kiwi remains at a disadvantage due to its lower central bank rate of 2.25%. The interest rate differential continues to favor the US dollar, making long Kiwi positions expensive to hold. Returning to the daily view, let's discuss our reasons for being bullish or bearish in the coming days. To be bullish, we would need to see a confirmed daily close above 0.5890 and the 20-day EMA to shift the near-term bias. A move above 0.5930 would be even more significant, potentially signaling a recovery toward the 0.6075 level over the next year. However, the bearish case is much stronger right now, given the declining EMA and the dismal GDP growth figures. We are currently bearish in the short term as long as the price remains below 0.5860. The long-term outlook also remains cautious, as any further escalation in Middle East tensions will likely keep the USD supported. The RBNZ's dovish lean and the potential for a rate hike only by May leaves a significant gap in time where the Kiwi could lose more ground. Watch the 0.5770 support level very closely. A breach there likely leads to a retest of the multi-year lows near 0.5510. Conversely, if the 0.5825 support holds firmly, we might see a period of sideways consolidation between 0.5788 and 0.5888. This range-bound activity would require a breakout on high volume to confirm the next major direction. To recap the key price levels for NZDUSD, keep a sharp eye on 0.5825 as your primary support and 0.5890 as your primary resistance. Our unbiased prediction is a 65% likelihood of continued bearish pressure towards 0.5770 within the next 2 weeks. This scenario is reinforced by the declining moving averages and the overall strength of the US dollar index. The 35% probability of a bounce towards 0.5930 would require a significant de-escalation in geopolitical tensions or a surprise hawkish turn from the RBNZ. Look for the U.S. Producer Price Index and President Trump's upcoming speeches as major volatility catalysts. If you are trading this pair, ensure you are using tight stop losses around these pivot points to manage your risk. The market sentiment is currently 63% long among retail traders, which often acts as a contrarian indicator for further downside. Thank you for watching this in-depth analysis on Explain the Charts. Please remember that this video is for educational purposes only and is not financial advice. Always perform your own thorough research and consult with a professional advisor before making any investment decisions.